In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, happy Thursday to all of our market rebels, and welcome to Coach's Corner. And Stu, market's still chugging along in the right direction. I think we were up about, 1.5 or so on NASDAQ and maybe half that on SPY.
Yeah, a little bit more, kind of flat. That was flat. Yeah. Just chugging along. Nothing really that we're expecting either way. We're going to have jobs tomorrow. And other than that, I'm just kind of seeing it coasting to the end of the year.
That's what I think we're going to do, unless there's any outside news. But as far as market news, I think it's pretty much all out. But one of the things that we like to bring to all of our viewers out there on Coach's Corner is not only to teach you about options, but there's a special angle. In most cases, it's to show you why it's so important to understand all of the nuances. I always call them the moving parts. There's lots of moving parts with options. And if you don't understand them all, you're going to end up stepping into traps. So we like to show you where some of these little nuances are, at least in most of the presentations. And that's what we're going to do today, Stu.
And that trap, everyone, can cost you money.
It can cost you a lot of money.
It can cost you dearly.
And especially for all the traders that like to pick up nickels in front of bulldozers and sell these options for 50 cents and cap off their upside, they get hit with one bad trade, and now it's 10 years to dig out of it.
It's a tough, look, some things you cannot control. What we're going to talk about is
market's one of them.
Is a piece of it is not in your control. But you have to be aware of the potential pitfalls of that kind of a product. And if you don't know your product, you probably shouldn't be trading it.
That's a good piece of advice. So let's take a look at what today's topic is. As always, we like to start off with a little segment that we call Chalk Talk. It's a little thought question. So if you're new to the channel here we go. You bought the 2000-2005 OEX call spread. Now, the OEX is an index. So you bought this OEX call spread for $3, $5 difference in strikes. And the question is, what's the most you can lose? Now, if you're thinking, well, gee, I've traded spreads before, and this is an awfully easy answer, stick around, because as I just said, we like to show you where there's little traps. There's a little clue for everyone, Stu. Now, I know this is where we're heading with this.
Yeah, and let's kind of not give it away. The best I'm going to say at this point on this one is, it's not what you think.
It's not what you think. That's always a pretty good clue for Coach's Corner. We're going to give you the questions. Probably not what you think.
It's not.
So today's topic is, there we go, vertical spreads on American-style cash indexes. Now, for those who may not know, there's two styles of options in the market. We have an American style, and then there's a counterpart that is called a European style. And those names have nothing to do with the continents or where they're traded. We have European style here. Europe has American style there. It's just a name. Not a very good name because it's not very descriptive, but an American style option call or put, can be exercised at any time.
Anytime, which means you can be assigned at any time.
Which means you can be assigned at any time. A European style can only be exercised at expiration, but it's really important to understand that does not mean that you can't close them. You can always close an option at any time, even if it's a European style.
Yep, between the opening and the close, as long as the options market is open and there's
it's open, you can always close it.
You can close it. Yep.
Yep. So there's a little actually quite a potentially big particular problem, which is why we have it as a topic today. When you're dealing with American style cash indexes.
Yep.
All right. So that's where we're going with this. So let's start off with a kind of a standard debit spread with equities, which is what most people are used to trading. And we've done this as a little segment before on Coach's Corner, but let's look at it from a different angle. So here's a typical debit spread with shares of stock. Let's say that you buy the $100 call, you spend $5 for it. Mm-hmm. You sell the 105 call, you collect $2. So on a net basis, you've spent $3. That's what we call the net debit. And this would in fact be a bull spread.
Yes.
The way we can tell that is that call options are bullish. We are buying the lower strike.
Well,
and all things equal,
bullish
the
if
lower
you buy them, bearish if you don't.
Correct. All things equal, the lower strike calls are more valuable because they give you the right to buy at a lower price. And that's the one that we're buying. If we were selling it, it would flip it. It would be a credit spread, but then it would be, as Stu said, it would be bearish. So that's a way you can kind of back into it and tell that this is a bullish spread. And that's again because we are buying the more valuable of those two strikes. So we've got a bull spread. This is what it looks like. So here's our maximum loss. Here's our maximum gain of 2. Now, how do we get the maximum gain there, Stu?
Well, I think at some point, if the stock goes far enough in the money or actually time goes by, we're going to lose our extrinsic value and the deltas are going to go to net 0. Each of them will be 100. And the value of that spread, not one or the other, but the net value of both of them will be 5.
That would be the best. In other words, you have the right to pay 100 to buy the shares at 100. You have the obligation to sell them for 105.
Right.
So if you're buying stock at 100, selling it for 105, the very best you could put into your pocket is $5.
Now that's not you. People often get that confused with, well, how much can I make? That you got to remember, you paid something for the privilege of having the opportunity to get 5.
Correct. So the spread. So if you're putting yourself at expiration, the stock's at 105 or higher, the spread would be trading for 5, but you paid 3. So remember, this is called a profit and loss diagram. It's not showing you what the spread is worth. It's showing you what the payoff, showing you what your profit is.
Yeah.
So now let's say that the stock is up here at 105 sometime and you get assigned, or some people say I got exercised, but the proper term is you got assigned.
You got assigned.
And so what this means is that the person who bought the 105 call, remember, we're short it, somebody bought it, submits exercise instructions, and what happens? We're now short 100 shares of stock.
Right. You delivered 100 shares. That's your obligation.
Right. And I shouldn't have put $100 there. You're short 100 shares. So what you do now is you're saying, okay, no big deal. I get the notice tomorrow. And I say, no big deal. I'll exercise my $100 call.
You're right to pay 100.
Because I've got the right to pay 100. And remember, I collected 105. So I've got the cash. It's no big deal. Stock could go to 110. It could go to 200. It doesn't matter. I can always pay 100.
Yeah.
So if I exercise, I'm now long 100 shares. They cancel out my short 100 and everything's good. Yeah. In fact, it's a benefit.
Yeah, big benefit. I think, at that point, the game is over. You collected what you set out to do. You got the full benefit of it, and you don't have to worry about anything moving forward.
Correct. So let's find out exactly a little bit more about why that's a benefit. And as always, for anybody new, please check us out at marketrebellion.com/get started. We have great videos, training materials, things to help you get started with your options trading, and absolutely free. So check that out if you're looking for other materials to help you get started. So let's take a look at the early assignment here. You're short shares of stock, as we just saw. But stock prices can fall, as we all know, and that is a benefit, provided that you're holding the long call. So remember on the assignment, we just showed that we would owe 100 shares. That's what we have to deliver. And if the stock price falls below the 100 strike, that's actually not a bad thing. Instead of exercising and paying 100, we'll just go buy it for 99 or 98 or 80.
Don't exercise your right and just buy the stock back that you sold at 105.
Right. So it actually becomes a benefit if you get assigned early on a vertical spread, because you are getting your full gain early, right? Let's say we've got a week until expiration. Stock could be at 105 right now, but there's no guarantees it's going to stay there. And we would need it to be there at expiration or higher to get the $5. But now somebody's saying, you know what? I'll just give you 5 guaranteed today. Hey, great. More of that, the merrier. And yet, incidentally, we also get a free put option. So think about it. If we are short shares of stock, but we own that $100 call, synthetically, we are long a put. Now, again, if you're new to options, there's a whole kind of branch of options trading that's called synthetics. They're just mathematical equivalents. And it turns out if you are short shares of stock and long a call, those two positions will behave exactly the same as if they were a put.
Right. And the simple, easy, easy way to say it is, look, the stock can go down forever, right? It can go down. Nothing's going to stop the stock from going down.
Right.
And the
zero will stop it. But there's no options in there to stop it. There's no spread anymore.
There's no obligation. There's no right. All you have is the right to pay 100. And if the stock keeps going down, your right to pay 100 may go to zero, but the stock can keep going down. And that's what Bill's talking about it, right? It acts exactly like the put. The stock keeps going down. You keep making money on the stock. The call stops going down because it can't go negative. It can't go lower than zero.
That's why we've got this flattened portion. So what happens on an early exercise?
It's the other side of the buy rate, the covered call.
Right. What happens on an early exercise for a vertical spread is that in this case, we got our $2 guaranteed. Now, do you see how this red line sits completely above zero? Zero is the break even. And again, let's say if we had a week to go and the stock was here at maybe 105 or 106 and we get assigned early, that spread's not trading for 5. Might be close, might be 4.5 or something, but it's not 5.
It's not 5.
It's not 5. And yet somebody is now saying, you know what? Let me just give you the full 5 guaranteed, and I'm going to do it early. So that's what causes that line to sit up above zero, in this case, to our maximum gain. But we've also picked up this tail for the reasons that Stu's talked about. And that's the only condition where you can actually make more than the difference in strikes on a vertical spread is from an early exercise, from the short side or an early assignment. So it's not a problem to be assigned early if you have shares of stock. So this maximum loss that we saw is no longer an issue. So when we have a debit spread with shares of stock, that's important. You're going to lock in the maximum gain. Mm-hmm. You're going to lock it in early. But now you've also freed up or created the potential for unlimited gains, which you didn't have before.
That's your tail.
That's your tail. But we did reverse the direction. But hey, who cares? It's a lottery ticket anyway, whether it was to the upside, downside. I don't care. When I put the spread on, I knew the very best I could ever get out of it was 2. I get 2 guaranteed early. And then somebody says, by the way, you've got a free put option in your account. Great. Nobody's complaining. So there's nothing but benefits in that, which is another way to show why it's a really bad idea for somebody not counting the dividends to exercise early.
I was just going to say this is not inclusive of the whole dividend thing.
That's
the numbers on the dividend and the time to export, the cost of carry and all that all that stuff kind of factors into this. This is a simple example of there's just really nothing else going on. Why would I not want to have the free put to the downside? And it's free because you kind of have to assume that if you're getting assigned on the 105, that it's going to be pretty close to 100 delta. That the extrinsic value is basically gone or very, very close within pennies of being gone. And because of that, the 100 is as well, right? Even more so, if that's possible. So actually, if you went ahead and exercised your 100, which you wouldn't do if it was below 100. But at some point, if you wanted to, you're not going to lose anything in the extrinsic value. And that's how you get your $5 out of it.
Which is why this line is flat all the way down to 100, because as Stu said, your deltas are pretty close to 100 on your long. They're pretty close to short 100 on your short shares. So you have a free put, but it's out of the money, right? We're assuming
it's out of the money, but it's a free shot. It's a free shot.
Right.
And I've seen this happen plenty of times.
Oh,
especially on earnings. The stock runs up. So on Netflix, maybe a year ago, 2 years ago, the stock ran up. It was through the moon. Yep. And I think the stock was like 285.
Yep.
The after hours came unraveled 325, 330. And that was on Wednesday. And by Friday, the stock was actually trading at 275.
That's right.
Had you been assigned, or had you sold your shares in exchange for, which you could have done in exchange for the short call that you might have had on the vertical spread, you were sitting with a free put, and you really made out like a bandit.
Yep. So the thing is that, as a quick recap, we're starting off with shares of stock or an ETF. And what we're trying to show is that if you have a vertical spread, in this case, we're looking at a debit spread, and you get assigned early, no harm done. It's actually just a big basket of benefits.
Yeah.
But, and this is really where the start of our presentation is, we just wanted to give you that background to show you why there's a discrepancy.
Took us a while to get there, but yeah.
In between these two types of potential underlines. So remember, with equities, no harm done. But things change with American style cash indexes. And this is where most traders say,
right. When Bill's going to you that the deliverable is different, and that makes all the difference here. So go ahead, Bill.
So the traders will say, I've been trading vertical spreads forever. I totally get vertical spreads. Let me just do it on a cash index. And it's a different animal. So now what we want to figure out is why. Why is this different, and what are the risks? What are your maximum losses? Well, let's start off with a cash index. It's called a cash index because it settles in cash.
Not the deliverable of stock like an ETF.
Exactly. So, for example, if you're trading SPY, SPY, that's an ETF. If you exercise it, you're going to get 100 shares of SPY. It's called an in-kind delivery. Cute. But if you're trading SPX, which is really the same index, but the SPX is the index.
The cash index.
You can't trade the index. So what they do is they just settle for the difference in cash. And we'll look at an example here in a moment. But the thing to understand is that the value of cash doesn't change with changes in the stock's price. See, what Stu and I were just talking about, we showed that if you get assigned early on that vertical spread and the stock falls, hey, it's great. We might make even more money. And that's because the value,
you got 105. That number's not going to change if the stock, they are mutually exclusive.
Yep. So it's not going to harm you at all to see that stock price move. And that's because the stock price obviously falls as the stock price falls. It is the underlying. But you're going to see that that's not true for cash. And this is where the trap is set. The stock can fall, but cash is cash. The value of that cash doesn't change. So as a very simple example, let's say that we have a cash index that's trading at around 100, and you've got the 100 call. If you exercise it, you're not getting 100 shares of this index.
What are you getting?
What are you going to get? Well, if the index is trading for 100 and you exercise it, which would obviously not be a good move, you're going to get the difference between 100 and 100, which is 0. If the index is 105, you have the right to pay 100. They're going to pay you not 100 shares. They're going to pay you $5 cash times 100. Multiplier is usually 100, or $500 cash. But notice it is not shares. I'm going to keep harping on that because that's the kicker. If the index is 110, how much do you get? Difference between 100 and 110, you're going to get $10 or $1,000 cash. Index at 115, you're going to get $15 cash. But anything below, again, there would be no reason to exercise it. But if you did, it's not going to be negative. You're just going to get 0. But the key to see, and this is where, again, where most traders miss it, there's a very big difference between receiving 100 shares of stock versus cash. So now let's do the same example that we just did, Stu, but we'll use different numbers, but let's do it with the OEX. And this is an index. Now this is actually the S&P, same S&P as the S&P 500, but it's the S&P 100.
Yeah.
And it actually stands for, a lot of people don't know this, it stands for Options Exchange. It was created by the CBOE, the Chicago Board Options Exchange.
I think it was in the early 90s. Bill.
Yeah, it was very, very early on, one of the first kind of big options indexes. So let's say that we have a trader now. Again, we're going to do the same spread, different numbers, but still a vertical debit spread. We're going to buy 10 of the 2,000 strike calls. That's where the index roughly was trading when I shot this. Let's say trading for $5, you're going to sell 10 of the 2005 calls for 2. Net debit of 3. It's exactly what we just saw. But the question now is your maximum loss 3? See, that's an easy answer if we're trading shares of stock or an ETF. Yes, your maximum loss is 3. But because we have an American-style cash index, we have 2 big potential risks. This is where these are where the traps are set. The first one is it's American style, which, remember, the long position can exercise at any time for any reason. And number 2, it's cash settled. It's a double whammy.
The American style means they can exercise, like Bill said, any time, which also means that you can be assigned at any time.
And because of this, most brokers charge what is called a ghost requirement. If you've traded spreads, you know that it's a 100% margin requirement. You would have to pay $3 or $300 total. And that's it, because that's the worst that could ever happen. But if you're trading this spread, in your mind, you'll be thinking, oh, I'm going to get a $3 or $100 margin requirement. Nope. They're going to hit you for potentially another 15%. And this is why we haven't gotten there yet, but it's because of this problem. So here's where the problem starts. If you get assigned early. All right, so let's say that the OEX rises to 2010 and you get assigned.
Remember, you're short the 2005s.
You're short the 2005s. So the person that exercises this is the closing price. And it's not when they exercise. It could have been trading at 2012. Doesn't matter. It closed at 2010. So they're going to say, all right, Mr. Trader, you've got the 2005s. The difference between that is 5 times 10 contracts, or 1,000 multiplier is $5,000. You got $5,000 cash coming to you. Here's the problem with it. Let's say I'm the person that has the vertical spread. I find out about the assignment the next day.
Right, because assignments take place, overnight. Overnight. OCC does it overnight. You get the assignment the next morning.
So let's say I'm thinking, let's say as a novice trader, I'm going, hey, I know this from my equity spreads. Not a big deal. I'll just exercise my 2000s.
Yeah,
and I'll have the cash.
Yeah.
Problem is, remember, what if the index falls? Let's say that the index falls to 2000. What do you collect upon exercise? Zippo. Now your net loss is 5,000 plus the 300 that you paid. Well, that's a far cry from 300, which is what you're thinking, or 3,000.
Yeah, that $5,000 is the difference between the settlement price and the strike.
Yep. So you still owe $5,000. And what we're going to show here is that even if the index falls, so again, it would be different if we were trading shares. That would be a benefit. But what if the OEX falls to 0? You still owe 5. Doesn't matter. The point is, if it did, you still owe $5,000.
Right.
See, that's different when you've got shares of stock. If the stock goes to 0, hey, that's even better. We'll just buy it for 0 and deliver because we're required to deliver 100 shares, not a certain dollar amount.
Yeah. And remember, this is a $2,000 number.
Oh, yeah. It doesn't take much.
$10 is nothing. I mean, literally nothing. Right?
Nothing. So let's look at it graphically. I've actually got a slide about that. Here's our vertical spread. There's the long 2000. There's the short 2005. And again, we said hypothetically that the stock is up here at 2010. You get the assignment notice. You owe $5,000 cash. And again, you're thinking, hey, no problem. I'll just exercise my 2000 and I will have 10,000 cash. That's the difference between 2000 and 2010. And I can cover the exercise. It's going to be a 5,000 gain minus the 3 that I paid. There's the $2 gain.
So, Bill, quick question here. So, if it's 2010, the exercise, is it based on the 2010 of the closing price of that day as well? Like it would actually be the following day after the assignment.
Exactly. See, that's in my mind. I might be saying, hey, this guy exercised for 2010, so therefore that's what I get.
Right.
But what if, remember,
so you come in Tuesday morning and you say, oh, I got a sign. And then Tuesday on the close, the stock is 2,000. You can't really exercise. You're not going to get anything.
Right. So let's do
That's
that.
a whole day worth of trading.
So let's say that the stock falls down here to 2,000. Now that might sound like a big move. It's only 0.5%.
Mm-hmm.
So remember, you don't find out about it until the next day.
Yeah.
That's the kicker. So now you're going, holy smokes. If I exercise now, I'm not going to get 10,000. I'm going to get 0. And instead of a 5,000 gain, it's a 5,000 loss, not counting the 3,000 I already spent.
300.
You know, you're going, this is just, so this is where the problem lies, is that the value of the cash doesn't change. And, but whereas with the stock, it does. The value of the stock obviously falls as the stock price falls. So do you see the difference? I want to make sure that all the viewers see the difference.
When Bill's saying the value of the cash doesn't change, he's talking about what you're obligated to come up with.
Correct. You're obligated to come up with 5,000.
Unlike the stock deliverable, which does change price.
Right. It's a little bit like a short sale. If you understand a short sale, that's the reason that a short sale works. Because you're shorting, let's say, 100 shares of stock, and you owe 100 shares of stock. And if the price of that 100 shares falls, then you make out by buying it cheaper and delivering the 100 shares. But what if your broker said you shorted $10,000 worth of stock and you owe $10,000? Now it doesn't matter where the stock closes or how far it falls. You would never be able to make any money.
That number is not dynamic. That number is a static number.
It's static. That's the key to see. So now it gets even worse. This was a debit spread. What if we used a credit spread? Well, now things can get even worse because the short position is even deeper in the money, and that's the one that you don't own. Somebody else owns that. So what happens at the index doesn't need to move as far to make the long out of the money. So watch this. Let's say that we sell the 2000-2005 put spread. It's still bullish. It's going to have exactly the same risk profile that we just saw. Maybe we sell the 2005 puts, we collect 5, we buy the 2000s for 3, we get a credit of 2. And we get exactly the same risk profile that we saw. But notice that you're short the 2005 and you're long the 2000. What if the stock is down here or the index at 1995? Do you see how the short position is deeper in the money? It's a longer distance from 05 down here to 1995. So those are now worth $10,000 cash. They're 10 points in the money. Assuming we've got 10 contracts, but you're only 5 points in the money. So now you get the assignment. Hey, I owe 10,000 cash. No problem. I'll just exercise my 2,000. Now it only takes 0.25% before that's a worthless deal. And you still owe $10,000 cash. See, so this is why it's super important to understand all of the mechanics and the moving parts in an option and a strategy. Just because you've traded vertical spreads before, if you're trading something that's a little different animal, such as an index or a cash index, things can change. But Stu, this is exactly why traders fall into traps. They go, oh, the SPY is an index, and the QQQ is an index, so they're all the same. No, they're not.
We had a trader in we had a trader in a product that was an American style cash index, and the settlement, the assignment, and the settlement number was
different.
Everything. I mean, it was like, what's the settlement price going to be? What's the settlement price going to be? I mean, it made all the difference in the world. That's
a whole separate, maybe even another coach's corner, but difference between an AM and a PM settlement.
Yeah,
another can of worms to open up.
Is it the settlement price on the opening?
Right, or from yesterday's close?
Is it a congregate of all the openings in the index put together on whatever divisor they're going to use and then come up with the price from the opening prices? Or is it going to be a PM settlement on the closing prices?
From before. So many problems that can happen. So let's go and take a look at some other examples here. And before we do, please remember, marketrebellion.com/get started. Lots of free, great stuff for everyone out there. So here's one of the ways that you can handle or combat this problem. The OEX offers two styles.
Not to be confused with calls and puts, just two styles.
Right, there's two types of options, but there are two styles of options. One is an American style that we talked about, and the OEX is American style.
Yes.
But they made a counterpart. Now, not all of the indexes do this.
No.
But they use the XEO, which is just the letters reversed, and that is a European style.
Right. So if you want to trade the OE, what's the point? If you want to trade the OAX, maybe you want to think about getting away from the early assignment and trade the XEO.
Trade the XEO, and that would be a very big recommendation to do if you're going to trade these.
Yeah.
Don't subject yourself to that risk. And now you have no surprise early exercises. So you'll look at this and say, well, today's the last day. I can either close it or I can see that it's in the money so much and I can exercise it under the strong assumption I'm going to get assigned, and they'll clear out. But at least there's no surprises. Okay. So, Stu, let's talk about some of the other popular indexes too.
Yeah.
We've got the SPX, which is European style. It is a cash settled AM settlement. We just talked about that. It's going to settle the next. So if it was on a Thursday, it's going to settle on Friday's opening prices.
Friday's opening. So what they do is they take all the stocks in the index and they grab the opening price and they put it all together and they run it through the windmill, whatever they're using there to do it, and they come up with this is the price based on the openings of the stocks,
which could be very different from what it was yesterday. And
even to make it more like of a problem these days, because stocks are trading in so many different places. It's like, which one are we going to use? We're going to use the NYSE. We're going to use the NASDAQ. We're going to use BATS. Kind of which ones are going to be? Today it's a little bit of a problem, like what that settlement price is actually going to be.
Yep. And then on top of that, you've got settlement committees that can actually add some subjectivity into the values. It's those are all separate discussions. But now if you trade SPY, I mentioned that earlier, that's an American style. So again, what's called in-kind settlement, where you're going to be trading the shares. Vertical spreads are not going to have this problem that we're talking about here. It's not cash settled. NDX, European style, cash settled AM. So it's got the same problems as the SPX that we just showed.
Yeah, that's the NASDAQ.
QQQ would be the kind of the counterpart, the analog to the SPY. It's the American style in-kind settlement for NASDAQ 100.
NDX, yeah.
We also have the SOX Semiconductor Index. That's an American style cash settled AM settlement type of option. You can run into the same problems that you can with the OEX that we just showed. Then there's the stocks with a double X. That's an American style in-kind settlement. Again, the shares are the deliverable. So if this is confusing and making your head spin, this is just a handful of them.
Yeah.
But the point that we want to show is that you have to understand all of the moving parts.
Yeah.
So one of the things
you got to pay attention. You get the XAU, the gold, you got the BKX, the banks, and you got all kinds of indexes. Who can even keep track of all the product that's out there these days?
Oh, it's very tough. So let's take a look at one thing you can do is go to Google. You could just type in like SPY contract specifications. That's the key term that the exchanges use. So I just created a link there. So here it is for the S&P 100, the OEX. And you come down here, exercise style is American. And so there you can tell, and it will tell you if it's cash settled. Okay, so where's our settlement down here? Right there.
That paragraph right there. See, look, using the last reported sales price in the primary market. Primary market of each component stock of the expiration date on the day the exercise notice is submitted.
Yep.
Which is not the same day as you got your notice, right? It's the day after.
Right. The day after. And we all know lots of things can change in a day in the markets.
Oh, yeah.
So anyway, we hope that helps. And one of the final comments here, always remember, it's not what you know that matters. It's what you have yet to see.
Yeah. In other
So
words,
you might say,
oh,
I trade verticals all the time. I know this about verticals. I know this about it. It doesn't matter what you know. It's all the things that you don't know, the things that you haven't seen yet, which is where the problems come up. So again, if you're new, or even if you've been trading for a long time, check us out, marketrebellion.com/get started. Sign up for coaching. You can get Stu. I think some of you saw Scotty on last week, and that'll help you to understand all of the moving parts.
Yeah.
So finally, let's go ahead and talk about this, Stu. You bought the 2005 OEX call spread for 3. What's the most you can lose?
Well, how about if I say more than $300? How's that?
More than 3 is for sure. Let's stretch the limits a little bit. What's theoretically? What would be the answer? Is there a limit we could ever put on it?
Not really. It kind of depends on the settlement of the OEX.
Yeah. You could make an argument.
Day.
Yeah. What if? Don't worry if it's probable. What if the index closed at 2015 and opened up at 2000, or went from 2010 and went to, or 2020 and went to 2000?
Or how about if it opened down 3%? Right, that happens.
Right, that
you get a
happens
gap down.
often.
The market opens down 3%. That's 60 points.
60
that's
points.
Serious dough.
Yeah. So don't think that it can't happen. And so theoretically, there's not really a number we can put on it. And we kind of guess that most people, when they saw the first version of this question, would have said, "Oh, that's easy. It's $3." And it's not even close to that. It could be far more.
It's all about the deliverable. Yeah.
And that's really what it comes down to. One is delivering cash. The value of cash doesn't change. Most of the time when we're dealing spreads, if they're on equities, you're dealing with the in-kind delivery, and that value does change. And that's the kicker. That's the big difference between them.
So what's the moral of the story, Bill?
How about if we go back to Stephen Levick? Know your risk.
My friend Stephen Levick, my colleague, well versed options individual.
Oh, for sure.
Areas as well. Know your risk, right? Just know your product. Know that ETF. Know your product. What does it deliver? Where are the holes? How can I lose? Always ask yourself,
how can I lose?
How can I lose?
And if you're unsure,
what am I not seeing?
Ask somebody.
Yeah, ask. Just ask. All you got to do is ask, right? The information's out there. It's not a secret.
Right.
Just got to ask.
Yeah. So we hope that gives you some things to think about. And we've got some other good topics coming up here in the can lined up here for some of the future Coach's Corner. So if you're new, it's great having you here. Please check us out every Thursday at 4 p.m. Eastern. Mm-hmm. We thank you for being here. We hope you learned something. We'll see you next week.
All right. See ya. Good one.
Good point.